Private equity is nothing more than investors buying stakes in private companies because very few single investors have the cash resources to commit to a range of opportunities. Private equity funds provide valuable access for investors to a well-thought-through range of opportunities. What are some of the factors that you need to consider before investing in private equity? On that note, gentlemen, thank you so very much for joining us today. Great to have you on the program. Emile, I think let's start off with you. Give us a snapshot in terms of what you do on a day-to-day basis as a private equity manager, fund manager.
Okay, well, thanks very much, Eleni. Generally, what we do is we, on a daily basis, really consider evaluating new investment opportunities, which we term really building our pipeline of opportunities. In addition to that, once we have evaluated opportunities, we are also enter into a due diligence process where we really evaluate the investment thesis and the attractiveness of the project.
Do you do it just here in South Africa, or do you look at private equity across the African continent?
Yes, our specific fund is an infrastructure fund that focuses on the entire continent of Africa. So yes, we also actually have offices in Ghana and Tunisia. So yes, we look at opportunities across the continent.
Kobe, where does private equity actually fit in the whole asset allocation puzzle? Because we know it's unregulated, so I suppose it falls where mutual funds and hedge funds actually fall. Is that right?
Yeah, I mean, if you think about private equity is notoriously liquid, as you said in your startup of the show. If you think about these investments, these are people making commitments to companies. They're waiting for a return for a certain period of time, and as they wait for this return, there's a whole bunch of stuff that potentially does happen or doesn't happen. It's not like you're buying an annuity flow out of a company and that you can potentially value that. So often there's some very specialist valuation techniques that private equity people make use of, and then obviously you want to be rewarded for that. So there's a return that you get.
So risk return, and we know the risk is also very high, right?
And then I'm glad Roland is not here today, because if you think about risk, you can't necessarily look at a standard deviation or a volatility number as far as private equity is concerned. I mean, if you're looking at risk in private equity, it's risk of default. It's risk that an investment will get kind of draw down to zero. I mean, is that true? I mean, there's no just volatility numbers. You can't just look at an index series and get like a volatility number out of it.
Yeah, there's nothing like tracking index, or investors don't have the comfort of knowing that they're going to be very close to listed returns. However, over the longer term, private equity has shown that it can outperform listed equities for that matter. And yes, essentially the risk is really involved in the fact that you invest in unlisted, unregulated type companies. How we mitigate that risk is because of the fact that we take a very much involved, hands-on approach when we invest. We do very detailed due diligence, mitigate project and company-specific risks. Things that we can also do that unlisted managers can't do, for example, is negotiate specific minority shareholder protections, specific exit routes that we very often negotiate in terms of the shareholders agreement. Those kind of things really mitigate our risk. And then furthermore, over our portfolio, we very often have one or two companies that perform very badly, but in the rest of the portfolio then makes up for those returns.
With regards to the life cycle, you're talking about exit strategies. Give us an indication. I know that historically between 8 and 10 years before you can actually exit. Is it longer than that for you?
Yes. As an infrastructure fund, we've actually got a term of 15 years, but the general private equity fund is a 10-year fund, where our investors allow us 5 years to actually deploy the money, so we don't get the money up front. We have 5 years to make our investments, and then another 5 years to exit our investments.
So after the 15-year period, what kind of returns can we expect?
We generally, exactly. We'll look at some.
I'm speaking for Roland today.
Yeah, I think you are. I think you are. How can you ask the guest a question like that? Eh?
It's very important. It's all about returns, isn't it?
We're going to look at some statistics later on, where over longer term private equity has yielded 20% plus type returns. In an infrastructure fund like ourselves, the risk we believe is slightly lower because of the contractual nature of the investments that we make. And hence we also targeting a 20% type IRR for our funds.
Okay, after 15 years, 20% return.
That's correct.
Just to
Listen,
clarify.
you drive a hot bargain, eh? You know what I'm saying? And the past is no indication of the future, eh? Listen, but Eleni, I think one of the big issues that we've got on the show is the fact that many people don't actually know how private equity actually works. So what I want you to do is I want you to just look at your screen now and have a look at this. And this is a typical private equity structure. This is kind of how these structures look. You've got investors at the top end of the screen screen over there, you can see various investors. Now, those might be private individuals, they might be life companies, they might be pension funds, but those are investors that are making a commitment to a specific fund. And there you can see we're just calling it Fund XYZ. You've got a general partner, which is the fund manager, which in this case would be somebody like Emil, and they invest in a range of companies. So you can see the companies at the bottom end of the structure. Emil, maybe a question from me. I mean, is this generally how most private equity kind of fund managers operate? They operate through this kind of fund structure, which is kind of this limited partnership, and then invest through this limited partnership. Is that kind of how this operates?
Yes, Kobe, that's very standard in the industry. Important to note also is that that the investors actually, as I said previously, commit money to the fund. So as the fund manager actually approves of investments and decides to make, for example, company A an investment in year 1, it requests those funds from the investors, and the investors then produces them. Company B and C might only be investors year 2, and we only actually get that money from our investors when those investments are made. So it's essentially a commitment that these investors make, and they don't give us the money up front.
Emil, why is private equity in a sense very secretive? It seems that there's quite a stigma attached to private equity, that we don't know very much about it, and I know that we're going to get to with regards to understanding the industry a whole lot better, but why does it have this aura of being very secretive?
Eleni, maybe that's just more of a historic thing. Industry bodies like SAFCA, MPA, etc., are trying their utmost to improve transparency. We also have, we'll be looking at some Rescura surveys, stats later on, where increasingly we are seeing bodies providing results in terms of how the private equity funds are performing, what kind of investments they're making. But essentially, the reason for that is that the private equity fund managers, in many cases, took companies out of public markets, took them private, did a lot of financial engineering, some strategic value add, and that is typically seen, a lot of what they're doing is seen as their own IP. And because of the competitive nature between different private equity funds, for example, my pipeline of the next 5 or 10 deals that I look at, that's my bread and butter, and I don't want to share that with anybody. So, I'm not going to tell anybody which deals I'm looking at, and therefore it's a very competitive industry as well, even though there are, they're not that many players.
I mean, a decade ago, if you look at private equity in South Africa, we saw a whole bunch of listed entities that kind of fell off the markets, off the kind of market board. I mean, much dismay to many investors because they were actually great companies, and they went into private equity hands, and some of them are lying with the big life companies today within some of their private equity vehicles. In other cases, they've literally just been held by kind of close-knit families and so on, which we call private equity today. Are we seeing more of that kind of happening, or alternatively, are we seeing kind of more kind of infrastructural type and smaller type businesses and developmental type issuance today, rather than kind of that as a form of private equity?
Yes, thanks, Kobe. That's the P2P or public to private type model, which we did see a lot of previously. It's very much associated with the leverage or leverage buyout model of private equity. Some of the biggest ones we saw was Etcon and almost ShopRite also coming off the market. I think you'll probably still continue seeing that, but probably more on the mid-cap market. The larger companies, really, the problem that private equity funds have is you really have to pay a big premium in order to convince investors of a very widely held asset like Etcon or ShopRite to come off the market, and hence your ability to really then generate a return going forward is more difficult. I think what has irritated some investors is, when a public company is taken private, and then 7, 8 years later it comes back public again, and it feels like you're paying a premium again and you sold it at a discount. But essentially, that's really the arbitrage that private equity also provides. It provides some kind of a value floor, and when public investors really underrate equities, a private equity firm will step up and actually take that company private.
And of course, we know why companies want to go private, because shareholders eventually want to sell out, right, of their stake. Kirby, life cycle, economic life cycle. When is the best time to actually embark on private equity investing?
Look, firstly, I think in my kind of summation of kind of the world and world economics, if you've got a cheap market environment. So this is kind of long-only assets. It's outside of the hedge and outside of the private equity market. Kind of the long-only market, the PE multiples are very low. You've kind of got this natural attraction into the kind of traditional kind of markets. It's only when markets start filling up that you start seeing private equity kind of start taking off, because that's invariably then where there's excess capital trying to find a home. But generally, I would say that good private equity people would make money through the cycle, because there's distressed opportunities on the one side, and then there's kind of valuation-based opportunities opportunities on the other side. And maybe, Emil, maybe this is a good time for us to kind of talk about the process, because there's a process that underlines private equity. If you look at your screen now, you'll see a typical private equity process, and you see how highly resource intensive this is. You start off with 300 deals that are evaluated, and this is now, I think we're talking specifically here about an investment team that Emil will tell us about in 2007. 19 deals proceeded to the detailed due diligence stage, and then only 8 deals get invested. That's hugely resource intensive. I mean, that's even more resource intensive than kind of long-only kind of equity space. Do you want to take us a little bit through that process, maybe?
Well, exactly, Kobe. Yes, these are some stats out of our own fund. And yes, even though we're a fairly small team, we're 8 investment professionals, this is the kind of evaluation that we need to take in order to ultimately invest our funds. And even though it sounds very, very short, doing 8 deals, we've invested more than 60% of our portfolio to date, and in a 4-year period, that's actually fairly good. What you have in terms of resource intensiveness is, out of those 300 deals, typically you would at the very minimum need to at least have a follow-on meeting with the client, evaluate their business plan, maybe even do a site visit, and at the end of that process, do a summary and evaluation, and then we present it back to our exco essentially. The reason we go through that entire process is because it's very expensive once we decide to actually pursue an opportunity. You can imagine if we do a power project in Nigeria or a telecoms project in Kenya, that essentially very often what you have is equity investors that invest with us, together with the debt providers, are all over the continent, some of them even Europe and US. We have to do on-the-ground due diligence, traveling there and fro, and then legal costs are astronomical. So we really have to make sure we know, we screen a lot of opportunities so that we can cherry pick the best ones for
Emil,
our fund.
with regards to criteria, the considerations that you take on with regards to when you decide on the 8 companies that Kobe was alluding to, what are the boxes that need to be ticked?
Yeah, I think I maybe talk more small sort of generalist in terms of private equity in general, but essentially the first thing that private equity firms look at acquiring a company is the management team. Essential that we back a strong management team within the company that can actually drive this investment, because we're very much financial investors. Although we add strategic value, there needs to be a strong management team. In addition to that, very important even for ourselves more so, is certainty of cash flows. So you would find your generalist private equity funds would invest in sectors like retail, consumer type sectors, where there's a fairly stable section of cash flows. For ourselves, we invest in power projects, for example, water projects, where very often our contract is with the government for a 20-year period, rates really agreed up front, and we know exactly what our cash flows are going to be. I think that's the important thing. And then secondly, you need to either identify some kind of strategic growth opportunity, whether that's vertical integration, regional M&A, consolidation, and then you also find some private equity players that really invest on the back of a macroeconomic theme, like urbanization or digital, sort of rolling out fiber into the market. And then finally, things that we look at entry is really how we're going to exit this opportunity. We need to very often even contractually agree in the shareholders agreement that we have a put option to somebody or exit at a certain multiple, so that we really have almost a fallback position if we do want to get out of the investment.
That's toughest business. I mean, if you think about it, you're trying to enter mid-stage businesses and mid-stage opportunities where there's some cash flow. So this is not venture capital where it's right at the bottom end, where somebody comes to you with an idea and says, hey, listen, why don't you put some money into this? I think it's a great idea, but I have no business plan, I have no ability and understanding how I'm going to take this thing to market, but it's a great idea. That's venture capital.
Yeah.
This is kind of mid-stage, and it's trying to, absolutely. This is mid-stage, and it's mid-stage trying to kind of attain the next level up. So that's how you mitigate your first level of risk. Then your second level of risk is how you're going to exit out of this thing and how you're going to get the J-curve moving as fast as you possibly can.
So options, I mean, you can take the company public or...
Sure, but you need a lever point for that. So you actually need an opportunity to come to fruition. You need to know something potentially that maybe some other people that they don't necessarily know. Emil, I mean, if you just kind of look, and again, if you look at your screen now, total funds under management split by geographical and undrawn commitment kind of levels, there you go, 2010, 66.6 billion kind of committed to funds, and there's over 31 billion of undrawn commitments, and that's in 2010. Those undrawn commitments are money that kind of just waiting to get into private equity in the South African space. Is that kind of the kind of numbers we're talking about? I mean, that's a lot of money.
Yeah, I mean, the 31 billion is what we call dry powder. Even though it sounds quite big, big essentially in the world context, it's fairly small. I mean, the world market is really $2.4 trillion assets under management of about $1 trillion dry powder. So what we have in the South African market is, yes, out of the 100 billion committed capital, 66 billion of that already invested into companies busy working for investors. The other 30 billion is, as I said, committed and dry powder. So as and when we decide to make investments, we will actually draw that 30 billion from our investors and deploy that into the market.
Another turn of events in South Africa, and this is after the financial crisis, a relook by National Treasury with regards to Regulation 28, and now there's an allowance from 2.5% into unregulated instruments, bringing it up to 10%, which includes private equity, it includes hedge funds as well. Why this change of heart by National Treasury, would you say, and what has the impact been on private equity?
Well, thanks, Eleni. That's firstly just very positive for the industry. Clearly, we believe, and we've been motivating that that pension funds and provident fund trustees need to have more flexibility in terms of where they invest their money. Listed markets, as we can see, on the very short term, has huge levels of volatility, and investors into those provident funds, don't really want that level of volatility, and they obviously balance that out through having bond portfolios, etc. But because of the fact that we provide asset classes both in the hedge funds and the private equity industry that are less correlated with the market, provides further diversification. Essentially, if you look at it, investors cannot actually get access to very good quality companies that are not on the bourses. Also sectors like, very often sectors like infrastructure, for example, venture capital, those kind of things, you don't actually have investment opportunities in many of the listed markets. If you want to actually, for example, have exposure into Africa, we all know the listed markets are fairly shallow in Africa, and in order to deploy large amounts of money, again, private equity provides that vehicle. So we're providing alternative vehicles for investors really to deploy money, and also, as we've proven before, yield better returns.